Welcome, guys. Okay, afternoon session here. We're going to be talking a little bit about fixed asset. We call it fixed asset training, but more specifically, depreciation, lives, methods, importance, kind of the prepared task, anything that's kind of involved. So, I think on a show of hands, maybe it's all of you, maybe it's none of you, but who's had experience with the fixed asset software, right? Who's added assets? Okay, so most of us have some familiarity. So again, I'm going to hit on some pain points, but again, I'm going to go through how the software looks, what we're looking for, some of the nuances, things like that. So again, questions, experiences, raise your hand, stop me, right? I've run into this issue. What was that? If I say something you didn't understand it, stop me, okay? All right, so again, this will be a little interactive too. If you guys have got questions, again, this is your time to learn. Okay, I think that the two things that we want to accomplish here is one, it's all about learning. I think in a session like this, and two, maybe Pete can agree with me, but this is also creating confidence in yourself, right? You want to be able to go through a tax return. Probably the most important part of a tax return, I think, from a planning opportunity, strategic, whatever you want to think about, probably the most important and the most applicable to every tax return is depreciation. Okay, so you guys are going to see it on your business returns 95% of the time. Okay, so we're hoping this is important. We hope you get something out of it. Why is this important? Again, we're going to talk about what is depreciation and amortization. We're going to talk about some of the methods, the difference between book, tax, and then when we get into tax, we've got some sub methods underneath the tax bucket that we need to consider when we're doing our fixed assets. Useful lives, why this matters, more important as we move today and forward. Kind of the current tax effect versus the future tax effect, maybe getting a little bit beyond the means of just putting in the fixed assets and generating depreciation and moving on. What are you really doing, right? Fixed asset software, I've got it pulled up down here. We're just going to kind of show you how that works. And then maybe some of the tasks for the prepare, what the reviewer's looking for, kind of what's your responsibility versus what's not your responsibility, okay? So depreciation and amortization, again, from the basic definitions under the code, right? Really, this is going to be an allowed deduction for property used in the trade or business. So if you think about a business, right, when a business purchases property, it's really going to fall into two buckets, right? I'm either acquiring inventory, right, that I'm going to purchase and then turn around for resale, or I'm going to buy some sort of tangible property to use in my trade or business, right? So we're going to focus on I'm buying something tangible, or sometimes in the case intangible with goodwill, customer list, but generally speaking, these are going to be tangible vehicles that, or not vehicles, but assets that I put in my business. So the common example is going to be vehicles, machinery, equipment, things that I'm using in my business to help my business run. The second part of this is amortization. Again, these are going to be non-tangible goods. So think about goodwill, customer list, things that it's an asset to me, but it's something that's not physically there, right? We've got required methods that we're required to use when we have an intangible that we acquire. Okay, so depreciation methods, and we'll kind of go down to this chart down here, but from a real high level, guys, I mean, we've got two different buckets of depreciation. We've got book and we've got tax. Okay, so book depreciation is when you're going to see if you guys work with any of the audit team or any audit review comp clients that just record book on a straight line depreciation basis, and then maybe some of the customers' financials that you work on that are not audit will also have book depreciation. But this is going to be pretty simple, right? This is just going to be straight line over its useful life. So the common example, a $20,000 vehicle is depreciated, $5,000 per year for 5 years. How about that? $25,000 vehicle depreciated at $5,000 over 5 years, right? Very simple. You're just going to take your useful life and depreciate it over the ratably over that time period. Okay, and like I said, this is a method used for GAAP. A lot of times this is either going to come from the auditors, come from the client, but I think we're a little bit more tax focused here. So we're going to take this information, okay, we're going to look at, updating fixed assets, getting the cost, but now we're going to start thinking about tax depreciation. So now we're turning on a different element from book depreciation. So tax depreciation has, I'm going to call it multiple methods. The default common method is what's called MACRS, which is the Modified Accelerated Cost Recovery System. And this is basically, if we think about book's got a 5-year life and it's got a straight line each year ratably runoff. The MACRS convention, without going into how it actually works, is I'm going to get a little bit more up front and a little bit less on the back end, but it's going to accelerate some of my depreciation. So we're always going to have, even if you use straight line for book and makers for tax, you're always going to have book to tax differences because they are not equal. One's going a little bit faster, the other one's going pro rata. Okay, so that's the difference kind of between those two. There's another one in here with ADS, which is the alternate depreciation system. I don't think that's going to be applicable. You're not going to see this very often. It's only required when we've got some elections out there for individuals who are trying to get around some interest limitations and stuff like that. Not applicable, but it's out there. It is available, but generally speaking, the most advantageous method to use is the modified cost recovery system. I put a note in here. Depreciation. The biggest difference between tax depreciation and book depreciation from a useful life mechanism is tax depreciation has required useful life. Okay, so let's go back to our common example up here of this vehicle that we added for $25,000. Management, auditors, for book purposes, they can basically choose their own recovery life. They could say, I think this vehicle is going to be 10 years. I think it's going to be 5 years. I think it's going to be 3 years. It's their discretion. They can use it, and however they want to depreciate that on that books, they're fine. Tax, we can't just come up with our own assumption. The IRS gives us a required life, okay? So the difference there is a lot of the times, there might be a disconnect where you might get something from the client, you might get something from the auditor. They're saying, what's this? This is a 10-year asset. No, it's not for us. It's 7. And there's got to be a determination of, and I'll show you guys in the software, we have tax columns and book columns. Okay, so that's something we'll discuss here in a little bit more about the useful life, and I've had it in the handout, but we'll discuss that a little bit more. And then for tax depreciation, okay, so you've got your you've got your straight line for book. For tax, you've got this modified acceleration convention, but tax, you also have opportunities to accelerate depreciation with 2 methods. Okay, so you've got bonus depreciation, which we'll go over some of these items in the chart below, and you've got Section 179 expense, and we'll discuss the 2 below. But generally speaking, so tax, book gives you 1 method, straight line. You do that over the useful life. Tax, they give you, we'll give you the modified, the makers is what we call it. We'll give you the makers method. Great. We're also going to provide you 2 other methods to accelerate all the depreciation as quick as you can. Okay, so tax, we've got a lot more options. Book is just pretty standard and easy. That's why we're tax people, not audit. All right, so what I want to discuss here is this is a chart that I've updated. It's on the handout. I think it's beneficial. I've actually referred to it a few other times, but this is kind of just saying, okay, if we circle back to our tax depreciation, we've really got, I'll call 3 methods that we can use under the tax. We've got your standard makers, which we've discussed, and then we've also got opportunities to accelerate depreciation with bonus and 179. So this is going to be our list of criteria for each method, and then kind of a description of what happens. Okay, so the first one, election required. By default, bonus depreciation is applied when you add an asset. If I go in to, for fixed asset purposes, if I go in and put a $10,000 asset in there, by default, it's going to calculate bonus. So the IRS says by default, you get bonus. If you don't want to take bonus, you have to make an election out. I don't want to use, I don't want to depreciate all this up front. I'd rather save some of it for the back end. That's great, but there is an election required. And that election comes, 1, you got to do it in the fixed asset software. 2, you got to attach the election to the return. And it's just something we do in the tax software. There's a box you check, but you can't just say, well, I don't want to do this and not make the election, because that can be detrimental. So the biggest point there is bonus default. And if I don't want that, I got to elect out. Okay. Section 179. It's on the form when you're filling out the depreciation form. There's really no election you kind of have to make. You're kind of making the election by filling out these boxes on the form. Okay, and we can maybe look at the 4562 form. Okay, so here's the 4562. Here's the first part where we kind of list, hey, I want to use 179. Here are the assets I'm using. There's no real election we have to make. We just fill out these boxes, okay? So election required to opt out of bonus 179. There's nothing needed, and then makers there's nothing we have to need. But that we're getting that by kind of default. So basically they're saying you get the default bonus. Tell us if you don't want that or not, and then we can move on with the rest. Which comes first? This is always a big question, right? Is it bonus? Is it 179? Like what comes first? 179 is the first. Okay, so section 179 and bonus, they're gonna have different what I'll call percentages of what you can use. There's some different criteria, but 179 is the first thing I can do. So I can use 179, and then whatever I can't use, I can use bonus, and then anything left after bonus uses maker. So if you think right now, guys, we'll talk about it right here, but bonus is at 60%. So I could use, if I buy an asset for $100,000, well, I can take 50 of 179. Okay, so now I've got 50,000 remaining. Well, now I can use 30 for bonus because I get 60%. Okay, now what happens to the remaining 20? The remaining 20 just goes through its regular 5-year course of depreciation based off of a calculation. So 179 first, because 179 technically reduces your basis. Then you get bonus, and then you get makers, right?
But you're not required to use 179.
No.
If you elect to use 179, the ordering is, I think, is what you're saying.
Yeah. 179 comes first, but that's only if you want to use 179, and you just go, you fill out that box, the 4562, and here we go. Okay. Which assets? This has been the rule for quite. I think everything changed back in 2018, but for now, new and used assets both qualify for bonus in 179. So really, any asset that you purchase is, if it meets all of the criteria, you're going to be able to use bonus 179. Big parentheses here, and this is pretty important. I'm sure Pete can attest, but bonus and 179 do not apply to related party transactions. Okay, a lot of the times as the preparer, you're probably not going to know if it was a related party transaction. But if I'm buying an asset, my company, I own 100% of it, is buying an asset from me. There's no bonus in 179 allowed, right? They don't deem that kind of as an arm's length transaction. It's just not going to work. Okay, so I'm putting that note up there. I don't think the preparers are necessarily always going to know that because you're not going to be 100% familiar with the client. But if you hear it's a related party, you can't use bonus for 179. Okay. Makers, same thing, new and used, that doesn't apply. Yep, go ahead.
Like anytime as a preparer, if we have to use or add assets, do you want us to just ask that question to the manager by default?
It's a good question. I think it's somebody like me, I would probably be proactive with you and say, hey, there was an asset in here, because if you're looking at 20 assets, I don't know if it's worth your time to go through every single one and say, oh, is it really a related party? Now, if you asked it, that'd be a great question. It's not going to be as applicable as you think it is, because usually it doesn't happen quite often, but you are going to see it, and I want you to just hear it, because if you hear I bought this from myself, or I sold this to myself, that should trigger alarms that sounds like related party. But again, the whole point there is, I would hope someone like me or someone who's got the client relationship would tell you before you add it. Okay, but it's a great question. I mean, should we be asking it all the time? We're probably a little bit more familiar, and hopefully it's proactive, but it will come about at some point. Okay. Depreciation rates. This is changing. This is what's changed for my slides. I had to update the slides from last year for a few things. 60%. So bonus depreciation is 60% now here in 2024. Okay, so think about busy season upcoming 25. We're gonna be working in 24. Bonus depreciation means I can take 60% of the costs that's out there as accelerated today. $100,000, I can take 60 today. The remaining 40 goes over the normal 5-year span of the calculation. That number, 2025, will drop to 40%, 2026 to 20%. Okay, so we can see this accelerated depreciation is coming down. Obviously, we hope by 26 there's something else out there that changes this, but as it stands today, this is the runoff. And I think it completely wipes out after 2026, but there'll be changes before then. But just want to make you aware of kind of the rates here. 179. 179 is going to be 100% of the elected cost. If I elect 100,000, I can use 100,000. The question is, can I use the 100,000? We'll talk about that below. But if I elect 100,000, I could use the 100,000. You can only use 179 on 80% of the asset. It's on 100% of what I've elected to use. And then the depreciation rate for the makers runoff is just a 200% double declining balance. Again,
Can you say that again? I think I fell asleep in the middle. I got confused. Do that again. The 100% for
of the 179, so you can use 100% of the elected cost if you qualify for all that elected cost. Right, Pete, if I added,
Okay,
yep,
alright, now you found
if I had an asset for 50 and I'm eligible to use all 50, I can use 50. I'm not subject to, hey, you can only use 80.
there's no haircut.
Yeah, no haircut.
Could you
Right.
use like 20 or 20,000
Absolutely.
if you'd like to?
You can elect
And
and
pick and
say,
choose on any assets. Like, hey, we have 6 ads, 3 of them I'm going to use 20,000 on. Okay.
yep, Max brought up a good point. So you could, theoretically at 179, I could buy an asset for 50,000 and say, I only want to use 20,000 as 179. Yes. Bonus, we don't have that luxury. You can't say I want to bonus half the asset. Bonus is just applied to the aggregate total. So 179, as you could probably depict, much more flexibility. Much more flexibility, but way more rules. Okay, and we'll get to them a little bit more down here, but you've got a little bit of flexibility in there, and we'll talk about this down below. Next line is where we're starting to get into some important facts. Depreciation maximum. Bonus, I can bonus however much I want. If I buy $10 million worth of assets, I can bonus up to 60% of all of that, okay? There's really no limit. I can just bonus whatever I want. 179, the maximum amount that I can use 179 is 1.2 million rounded for the total cost. What that means is if I've got $1.5 million of section 179, I cannot use all 1.5 as 100% of the cost. I've only limited to the 1.2. Okay, so I can't go over that amount. So most of the time when you guys are preparing returns, you're probably gonna be under the amount. But don't be shocked when you see some of these larger clients that have CapEx or fixed assets that are a substantial part of the return. They might have $15 million in ads. Okay, well, we know we can't use 179. Okay, we'll talk a little bit about the phasing out of the cost limitation down here. But generally speaking, if I have $1 million, $1.2 million or less, I can use 179. Go ahead.
I guess this is kind of with the related party too a little bit.
Yep.
If say like a client, like they had their business but they bought the machinery or whatever out of their own pocket and then like gave that, does that count as a related party, or would that go in as like a contribution and we can still take bonus on it?
So your question is I bought an asset outside of the company,
Yeah, I didn't use the company's cash, I used my cash.
but then you're contributing it into the
But
company.
then, but yeah, I bought it for the company with
Okay.
my cash. Is
So-
that, does
so-
that count as related party, or can we do bonus?
So if you think about related party is the transaction, the purchase. Okay, so if I'm the outside shareholder and I buy the asset, who did I buy it from? If I bought it from a dealership or somebody, as long as we're not related, there was no related party transaction in there. So the fact that I'm putting that into my business doesn't taint that fact that I can't use bonus or 179.
So it'd just be
Yeah,
contribution.
it was still an unrelated transaction. The whole point here is, I've got one entity and an affiliate entity. I own 100% of. Well, that one over there is super profitable, and that one over here is lacking. So I'm going to have them buy an asset from me at an inflated price so that they can get their 179 down, and I can use my. You can just play a game there, right? And I think that's what they're trying to get at is we're not going to allow that. But in your situation, I transact with somebody who's not related, and just because I put that in my business shouldn't change the fact that bonus ones can't be used. Okay. So, so we talked about the $1.2 million for section 179 limitation, no limitation for bonus. Another big one here, income limitation. Okay, probably the two biggest limitations here is my overall limit and income limit. Okay, bonus depreciation, we can use bonus depreciation to drive a loss all day long. Even if I'm at $1 million of loss, I can still take $1 million of bonus depreciation. Okay, bonus depreciation, I can basically use whenever, as long as I meet some of those other little rules. But bonus depreciation, I don't have a cost limit and I could drive a loss. Section 179 cannot drive a loss. 179 can reduce your ordinary business income to zero, but it cannot drive a loss. Okay, so there's a chance there where, okay, I've got $1 million of assets. Great, let's take 179 on all of them. Well, if my business income for the year was, $10,000. Well, I can use $10,000 of that million, but that other $900,000 I can't use this year. Okay, there's a carryover component that says, well, you couldn't use it all this year, and you can carry it over. Okay, but for the current year, you can't use 179 to drive a loss. Go ahead.
Can you do 179 down to 0 and
Yeah.
then bonus past that for a loss?
Yep, you could but you got to be careful though, because there's kind of like a reverse calc there. Kind of what's going to happen is depreciation bonus is going to be on page 1. Okay, so that's what will drive your ordinary income and affect what you can take for 179. So it's kind of like a double edged sword. You got to watch how much bonus is driving you down to see if you can still take the 179. So it's a tough calc, and you'd have to kind of mess around and see where your soft spot is. So yes, you can, but you got to be careful because one's driving one down and affecting the other. So yes, but it's a complicated calc to say the least. Okay. So the income limitation again, I could hey I had $1 million of ad. I'm gonna use $1 million of 179. If I don't have any income, can't use it. Carries over. Cost limitation. So bonus, we can add $10 million of fixed assets. Still use bonus. No cost limitation. Section 179, $3 million cost limitation. Okay. So what that basically means is if I buy assets, every asset I buy over that $3 million mark, it's going to reduce how much depreciation I can take from this max. Okay, so if I got $10 million of ads for the current year, you can't take any 179. You just don't. You're over the cost threshold. It's run out your course on this depreciation max. You just can't use 179. So again, 179. Although there's flexibility, a little bit more rules and regulations regarding amounts, how much you can use, whether you can drive a loss. Bonus, you're gonna have a little bit more flexibility, but then bonus is also capped at 60% of the cost. So that's kind of the main differences here. Last one I want to touch base on, ownership limitation. Bonus can be for everybody. See, C corps, pass-through entities. There's really no ownership limitation that's not going to allow you to take bonus. Section 179, as you can imagine, there's limitations. Okay, passive activities don't qualify for Section 179. So when I say passive activities, that also relates to passive owners. There's a 50-50 business between Pete and I. I'm 100% active in this. Pete's just passive, sits at home, collects the monthly checks. We want to take 179. Well, Pete's passive. Pete can't use that 179. So it does no good to send Pete that 179. So we need to be mindful of, some of these clients that we work on closely, Hope Family Businesses. Okay, there's 3 owners, they're all active, they got W-2s, we're under all the cost limits. Yeah, 179 is going to make sense. But sometimes you're going to run into a situation where there's going to be 10 owners and there's going to be a couple that are passive. And, they're going to be sent a deduction they can't take. Right. And so the main point here is 179. You can't just check 179 in the software and move on. Right. There's a couple other things you got to challenge yourself and say costs, limits, income, owners. Does it all make sense? Did they take it last year? Okay, then I can probably assume this year we can take it, but we just need to be mindful that there's a couple extra steps here to think about 179. But it's still a good answer, 60% bonus now, 40% bonus in the future, 179 is still a good answer. But we need to make sure we fit all the criteria because I'll tell you what, go ahead.
So as a passive owner, because 179 is a separately stated item, do they pick all of that up as ordinary income if we elect 179?
No, so you can't use 179 if it's sent your way. So the problem there is it gets shoved your way, Chris, but you can't use it.
Okay.
So really, at the end of the day, we want to avoid that situation. But if it happens to happen, it basically just gets added to your basis at the end when you have an exit event or sold or something. But really, what happens is it gets sent your way and you just can't use it.
Are you sure about that last thing?
Yeah, I think that's what we had. I had this situation with one. I think it was trust.
I thought it got pushed back into the Indian and just redepreciated.
It's supposed to. And I had a unique situation where it was passed out and we took it as basis. But Pete's right too. If it does get sent your way, it is technically, I think, supposed to get sent back and depreciated over time without using the 179. But again, every situation is different. I think you want to consult first or think about the ownership and who you're sending this out. Ultimately, the first reviewer, somebody's going to probably say, hey, we shouldn't be taking 179 because it's not a good answer. But we want to avoid situations where we send it out where someone can't take it. Okay.
The place that we might mess this up the most is there's 2 categories, and Zach touched on one of them. It's I sit on the couch collecting a check. By the way, I love this scenario because that is what I want.
That's what you would do, yeah.
Yes. The second scenario is real estate. Okay, real estate is always, always, always passive until it's not. And I think somewhere in the materials, we're going to talk a little bit about passive and what that means. So If I have residential rental and I buy a refrigerator, feels like I'd be able to take 179 on that refrigerator and write it off immediately. Nope, it's passive. Unless you're a real estate professional, which we'll touch on that a little bit, it's passive. So if it's passive where I'm sitting on the couch, I don't get that. The second is real estate rental. It doesn't work there either.
Yeah, so Pete brought up a great point again. We just need to be mindful of 179. I think the overall message there is great, great tool to use, great opportunity to accelerate depreciation. But there's more rules and criteria around this, and we can't just check the box and set it on, right? We need to think about ownership limitations, income limits, things like that, okay?
And the only reason this has become relevant at all
Yeah.
is because that line that says 60%, yeah, right there. 40%, 20%, because
Yep.
2 years ago it was 100%. So if you didn't have to worry about how much that put into the company in terms of PP&E, how much that purchased, what's my income limitation, is it passive, is it not passive? There's a whole algorithmic tree that you have to go through with 179 that doesn't exist if you can write off 100% under bonus. And the only time that you wouldn't run off, you would use under the old rules, is if you had a specific income target, and this is rare, but it does happen, and it's generally a negotiation between partners. If you're having a specific target, this election out of bonus that he talks about, if I have $10 million, I'm gonna make it $1 million of 7 year, and I got 500,000 of 5 year. Well, this says you can't just pick and choose. You have to elect everything out. So if you're going to write off 500,000, one 5 year asset that got $1 worth of value, you're writing off a full 500,000 in bonus. You can't pick and choose. In the alternative, in the 7, you write off $1 in that category. You're writing off a full 1 million. So you can't pick and choose. With 179, you can target an asset and say, I only want to take $50,000 or $200,000 or something associated with it. You can use a very targeted number with respect to 179 write-off.
Yep.
Prior to bonus depreciation starting ramping down, the only time you would ever see 179 is when somebody's trying to manage income.
And the NOL carryovers, I know, that's something we don't touch base here, but again, we'll discuss the importance of this 60-40% too, guys, because we'll talk about it down here below or mention it with the useful life. As Pete mentioned in the past, when it was 100% bonus, you could call something, so bonus, we'll touch a little bit more about the useful life, but again, bonus, generally speaking, applies to assets that are under 20 years, right? So think about bonus is going to apply to all assets, generally speaking, that aren't real property, right? We're talking about, buildings, obviously land doesn't have depreciation. So anything kind of outside of real property. So if you think about all your intangible property, qualified improvement property, which we'll discuss below, will qualify, but anything under a 20-year useful life, bonus is going to be applicable. So in the past, we've always said, well, I could call it 15, I could call it 5, I could call it 7, I could call whatever I want because I can use 100%. So in the tax world, we probably didn't really pay attention to useful life. You might see that when you look at the work papers, be like, why was that 7, 5, 3, where's the 6? Because it didn't matter. We could have called it whatever we want. Now that's not so true anymore when you have 60, 40, and 20. We got to start being a little bit more mindful and preaching about useful lives. Pete mentioned one other thing too, and I guess it's I'll mention it real quick. The election for bonus actually, it says election out is by class. So if you want to use bonus for 5 but not for 7, you can. You want to use bonus for 5 and 7 but not 15, you can. It's election out by class. So when I say elect out, you do have some flexibility there. And from a preparer standpoint, you're probably going to be talking with the tax manager trying to work that out beforehand. So I don't think you'll have to be messing around with that when you're trying to, that's when we're trying to hit targeted approach, like Pete said, we're trying to get to a target number. All right. Any questions? I know some people raise their hands, but qualified improvement property. We threw this in here. This was not in here last year. Adam Pfeiffer and I have worked quite a bit with this, and we thought it was good to share it with the group. But one of the biggest misses sometimes we have on our end is this qualified improvement property. So qualified improvement property for those that don't know, this is going to be an interior improvement to a commercial building. So I said commercial building, residential, single family home rentals, that's not going to count. Think about your commercial building, the building that we're in. Interior improvement to an improvement to the interior of the building that has been placed in service. Okay, so it's been around for a year or two. I can't call something a qualified improvement property the year I build it. It's got to be placed in service, operating, and then a year or two down the road, 3 years down the road, we make an improvement to the interior, just like what's going on behind you guys. Okay. The useful life is 15 years. Okay, so this is key because it's bonus eligible. It's under the 20-year property. 15-year useful life. Which assets? Interior improvements after the building is placed in service. Assets not included. Well, what can't be qualified improvement property? Well, some of the interior stuff, what they call structural framework. I'm not a magician. I don't know exactly what all falls under structural framework, but think, if I'm redoing stuff on the inside here that can be replaced, knocked back down again, taken out, that's generally going to be a qualified improvement. Structural framework would be, I would say, something like steel beams going through the inside are probably going to be a little bit more something that's structural, not qualified improvement property. But what we want to ask is, a lot of times you're going to get a fixed asset file and it's going to say leasehold improvements, right? The client rents out a place, they went in and made some improvements, just like we did here. What we want to stress is maybe ask an additional question. Just getting a leasehold improvement from the client is probably not good enough. We probably need to ask, what was the leasehold improvement, right? Was it furniture, desk? I mean, what was all involved? There was an office build out. So really, we're just saying most of the time it's going to qualify as qualified improvement property unless it's an elevator or structural framework. Roofs and HVAC are probably the two main ones that you'll see that actually do not qualify for qualified improvement property. Okay, they're considered part of the shell, what we'll call the building, the roof and the HVAC. But they are eligible for 179. Now we need to be mindful that 179's got all those limits we discussed. Okay, but the what we're trying to basically say is if I get a leasehold improvement from the client and they say it's 39 years because it's part of the building, you throw it in fixed assets, we depreciate for 39 years. Well, guess what? That could have been 15 years. We could have wrote off 60%, right? So if you think about a 60% of the write-off today versus a carryover for 39 years, what's the better tax answer from a time value of money perspective, right? So that's why we're asking that question. Okay, useful life, see handout. Again, you don't need to go through the entire handout. I think what I'm trying to stress here is, in the past, like Pete said, we've been a little, I should just say lax on useful life, 5, 7, 10, 15-year property.
You can say lax.
Lax. I think lax is good.
Lazy, don't give a shit.
Ignorant. I don't know. But again, we're trying to stress the importance now that you have this sheet. These sheets are with you. They're on the G drive. Or not the G drive, wherever the tax folder is on one of the drives. You have this stuff, and I would encourage you when something. If something doesn't seem right, you don't know what it is, refer to this sheet. Stop by my desk. Stop by anybody's desk. We've got appreciation handout books for stuff that's very odd that can tell us what it is. But this has got an impact moving forward because if we classify something between 5 and 7 year, it can have a dramatic impact. Now, next year even more when it's 40% bonus. So we just want to be mindful that hey, vehicles are 5 years. Machinery, manufacturing equipment 7 years, construction equipment 5 years. It's going to matter a little bit. So I want to just stress the importance of being mindful of these useful lives.
Well, so let's
Yeah.
talk about useful life
Yeah,
for just a second, because I'm sure it's probably in there somewhere. There's that revenue ruling.
Allowed or allowable?
No, that talks about. It categorizes things. It says this has useful life, like ag equipment.
Yep.
Outbuildings is a 10-year useful life.
Yep.
And there's a revenue ruling out there that you look at. And it's embedded in that depreciation.
Yep.
Book that he's talking about. So when you're inputting this, in general, you probably want to develop rules of thumb. A computer is
And
5 years.
And we have a quick reference chart that has just the bare minimums like, telephone, equipment, computer, car, that kind of is gonna give you a roadmap, 5.7. I don't know, I think it's,
Okay, so as somebody that has to input stuff into the system, you probably want to get a hold of that list. Because you're inputting it in there, and absent that list, you're guessing. So you probably want to get a hold of that list and figure out the common items that you put in there. And if you're working a standard nutrition,
here we go.
you probably want to figure out, what specialized ag buildings are and things like that. Okay, so
So we have a depreciation quick guide out here. It's out on the S drive.
Pig is a 3-year property. I should know that based on my dealing with standard nutrition. I didn't know that.
Yeah.
Okay, because like I said, I used to know this like the back of my hand. Now I know nothing. So, but you're going to be the first line of people that are putting something into the system, and knowing this listing from a general perspective is a really good idea. And if you can't find it on this listing or in the depreciation handbook, the default number is 7. I mean, that's right in the code. 7 years is the default.
A lot of times, if the client's already got a fixed asset about, you're gonna see that they had previous assets titled this. It's something new, right? So you'll have a general understanding, but if it's something you don't know, I encourage you just to look it up. This will be in a PDF. You can Control F. You can go in here and look, okay, does this fall under any of these? And if you're still confused, that's when it's time to ask for help. Okay?
But don't ask me.
Yeah, but don't ask Pete. Okay. Oh, and I have a note. Another thing I'll touch base on real quick, and this gets a little technical, but depreciation, there's a rule out there on recapture. Okay, so people probably talk about it when it's 1245, 1231, but generally speaking, if I depreciate an asset down and then I sell it later on, I have the recapture event saying I took an ordinary deduction. I'm gonna have to recapture it back as income. Okay, so those recapture items are something to always think about if you got a client who, well, I'm gonna probably sell this asset next year. Okay, do we really want to take the depreciation now and then recapture back next year? I mean, that's just a general rule of thumb. Pete will touch base on it on the 1245 stuff. I put a note in here called current tax effect and future tax effect. Again, sometimes we want to think about, let's accelerate as much as we can today, right? We want to pay the least amount of tax today, which helps facilitate keeping assets with us and not with the government, and we can facilitate growth or whatever we want to do, right? Most people are going to be tax averse that go in there and try to, lower their tax as much as possible. Pete might mention this too. I don't know if he said it yet, but we're getting in an odd stage here, guys, where bonus depreciation may not always be the best answer anymore. We've got an event coming here in 2 years where qualified business income, if you guys have dealt with that, is supposed to drop off. Okay, so a deduction in 2 years is going to be worth more in 2 years than it is today. And this is something that we need to think about. That's where useful life comes into play. Again, important there. Do we accelerate? Again, it's just depreciation allows you to front things, and that's generally what we're going to do, but we always need to be thinking about what that does on the back end.
Do you remember this morning's discussion about 2011, 2012? That's what he's talking about. Would you have wanted to take bonus depreciation in 2011, or would you rather have the deduction after 2011?
Yeah.
Connor,
After.
after,
And,
right?
and I'm not
that's,
gonna,
that's exactly what he's talking about.
I'm not going to say it's probably your responsibility, but it should be communicated with you, or somebody saying it. There's a reason, if I come to you, I'm going to tell you I want elected out a bonus. But it's always, if you ask the question, you might want, it might be for your benefit. So I encourage you to ask the question if you want to.
No, let me.
But I'm trying to go for it, Pete.
No, remember, we are here doing what?
To be experts.
Not to be experts, but we're drinking from a fire hose. And we're trying to gather information that we're going to create as reference points that we're going to build on a foundation, and what he's giving you is foundational. And if you want a trend to be more towards the consulting side, then you need to know something. And you need to take that something and be able to convert it to value. In 2011, I converted the ability or did the analysis for people to say, do we want to accelerate something into this year and reduce taxes because I know the rates are going down, or do we want to defer it? And I used things that I picked up over the years to take something that couldn't be a gain and made it a gain in 2011 and save somebody $2 million in taxes. Okay, but that's because I knew something. I used those rules. It wasn't just a tax rate play. So when Zach's describing, hey, you know what? If I'm giving you a tool or a question, what do we do, Sam?
Diagnose.
We diagnose. Okay. So what he's saying is, we know that there are absent any sort of tax law changes. We know that this is going to continue to go down. We know all these things. Now we have these items. Do we want to accelerate depreciation? Don't we want to accelerate depreciation? And to his point, if we're going to consult and what, Sam?
Diagnose.
We're going to ask questions just like what he just said.
Yep.
Do we want to accelerate? Don't we want to accelerate? This should be in your wheelhouse. You should know this.
Yeah.
You should know if I say I used to fail 351 in 2011 to accelerate a gain, does that mean anything? Hell no, it doesn't mean anything. You don't know that stuff yet. But you do know about depreciation on some level. You're going to be living depreciation for a while. And as you're living depreciation, you can go to Zach and other people and say, does this really make sense?
Yeah.
And you can pose the question, and to the extent that you now have taken something because you did what?
Drinking from a fire hose.
Drank from a piles allowed you to
Diagnose.
diagnose whether depreciation should be accelerated or decelerated, because you understand tax rates, you understand depreciation. This is not hard, but it should become less hard as you go, because we've built a foundation in order for you to be able to think, understand the landscape, and suggest an alternative. This should be right in your wheelhouse. You should not be passive on this. And the less you're passive about it, the more impressed Zach's going to be. God, Max was thinking. That's great. And when review times come around, are you going to call the person that's thinking a dud or a stud?
I'm gonna go with the 70.
Correct. So pick this stuff up and execute. Right? With failed 351, I'd never in a million years expect you to think about that, because you don't know it. But depreciation, I'm taking the guided tour, I don't give a shit, and I'm just going to put it in the system. It's going to show. That's what your mentality is. But if you sit there and go, should I or shouldn't I? And now I'm going to ask questions. Even if you look stupid because you asked a stupid question, that's better than taking the guided tour, because failure is good or bad, Connor.
Good.
Good. Why?
Because it teaches you.
Because it teaches you. We're here to maximize failure, to maximize learning, to not fail in the same ways that we did in the past. So,
Pete, another thing about all this too is when you learn this, you're going to have, I always think you're going to get confidence. And once you get confidence, you can get dangerous. You know, you can figure out problems, you can problem solve. Success story, real quick. We're talking about 179, okay? We had a corporation where bonus was driving a large loss. Okay? That loss would be carried over into next year as a net operating loss. We turned on our 179 tool and said, hold on a second, why would we use bonus? We're gonna like 179, and we had $1 million loss, so we turned it into $1 million of 179 that we could not use. Taxable income was zero for the corporation. So it's either a loss that we carry over to next year, or it's zero and the 179 carries over. So you're probably wondering why.
hold on. So let me splice that just a little bit, because I know where you're going.
Yep.
Okay. He's saying I got $1 million loss that's going to be captured into offsetting income next year. I think is what you're saying.
Yeah, in a while.
Or I got $1 million of 179 that's going to offset ordinary income. It feels the same, but it's not.
It's not the same. So the following year, this year, the client magically is going to be right around $1 million of income, taxable income projected. So we were going to carry over the loss that would offset that $1 million, but we got to think about there's a rule with NOLs currently. Those NOLs can only offset up to 80% of your taxable income. If I have $1 million, I got $1 million loss coming, but I can only use up to 80%. That means there's still $200,000 left that I cannot offset. At a 21% tax, there's 40 grand. We changed it last year, to flip that to $1 million of 179. Well, guess what happens when 179 comes over? There is no 80% limitation. Hit all $1 million, we're at zero. So just by changing bonus in 179, we were able to eliminate zero tax this year versus 30, 40, 50 grand, whatever it would have been between Fed and state. So that was because we understood these rules. and how that works, and then a little bit of the NOL. But those are items that hopefully after a while you learn this, you do a few reps this busy season, you can start incorporating those strategies that clients would be very impressed, right? So that's kind of the goal here is we will eventually get you there, but we got to start somewhere, and that's kind of where this is. Okay, I'm going to kind of breeze through this a little bit, but I'll show you a little bit of the fixed asset software, but when to reach out for help. Again, you guys, if you've dealt with this before, but if you've got fixed assets, this is from a pure practical standpoint when you're entering them in. If you've got 10, 15, 20 assets, do not enter it in by hand. Okay, do not go into the software and click file, new, add assets. I don't even know how I'm doing it because I don't ever do it, but if you're adding them hand by hand, could take you an hour, hour and a half. We have tools, people in place to import these in 2 minutes. So please do not ever go in and input assets by hand. 2 or 3, okay. I always say the cutoff should be like 5, 6. If you're over that amount, then let's just import it, okay? And then I put unsure of useful life, which we've talked about, and then bonus 179. A lot of times you guys are gonna pick up the return. You don't know everything about the client. It's okay to say, hey, we think at 179, we think at 179 or bonus. The manager on that's gonna know, right? And it's always good to get up front because you guys are soon gonna realize if you haven't already, there's nothing worse than preparing the work papers, having depreciation done, and then having to go back and make a change. It can make your life very difficult. So we want to try to get this stuff accurate up front. Task required by the preparer. The preparer is always going to go in, roll the fixed assets. I'll show you kind of how that is. Making sure everything's in there. We're in the right period. Determining bonus 179 with the tax manager. Any state differences. I guess, I don't know how hard Kaylee harped on that, but we have been talking, I probably should have said this up front, we're talking about federal depreciation. There's a whole nother world out there when it comes to state depreciation. Some states say we'll roll with the Fed. Some want to do their own thing. We have to account for that. Nebraska and Iowa are now both on the same page with the Fed. But again, there might be a state like California who just does their own thing. We've got separate tools in there to separately track it, but that's another thing we always need to keep in mind when we're doing the fixed asset software. My live's good, my cost's good. Bonus 179 is the state updated to run these depreciation differences. Just taking your time the first couple reps if you're not familiar with it, understand it, challenge yourself. If you're looking at something you're like, hey, I don't even know what does this button mean? Just look at it. Take a second to think about it. I mean, the more you get familiar, the more you'll understand really the entire technical and application process. I think that was just about everything I wanted to cover from a fixed asset standpoint. I'll touch base on here on the personal property taxes, which we'll show you. So if you haven't been in the fixed asset software, this little purple icon, fixed asset CS, it's probably on your desktop or you'll run into it. It's somewhere in there, okay? You'll get in there, you'll go to file, open client. There's a list of clients in here. I've got my own test files where I mess around, but this will be name, client ID. You can really go in here and kind of find which client you're working at. So, let's just say I open up my file. I'm in here. I have no assets in here, but first thing if I'm the preparer is what fiscal year are we in? If nobody's touched since last year, this might say 12, 21, 23. What year are we in? We're in 24. I need to roll that forward. Okay. Sometimes you get caught up in the moment. You may not even realize you're in 20. The biggest mistake I've always seen is people forget to roll the depreciation file forward. Okay, so there's this little earth button with an arrow kind of symbolizing the time, I think is what it is, but select period of process, click on there, close to next year. Okay, it just says you're being closed, advancing depreciation, great. Well, now I know I'm in the right year. I'm in 2024. All my assets carried forward. Now I'm ready to go in there and add my own assets. Okay, so I said we should never add assets, but if we do have to add them in here manually, first things first, most of the time you're going to see it under business. You might see one under rental, but maybe being a little cognizant of just taking time when you're first in there. Where am I at? Where are the assets? Edit, add. I might put in here a BMW, right? Okay, date service is 0101. Yeah, that's supposed to work. There we go, 2001, how about that? So I added the description, date and service, if it's tied to a group number here, okay, group number, right? Vehicles. Basically, the client will tell you kind of what group number it's in. Vehicles, leasehold improvements, things like that. And then a location if they're trying to track assets by location. You'll get a gist for when you open up the file, what group it's got to go under what location. Biggest. Let me see if I can get this rolling here. Bear with me, it's moving a little slow, but okay, tax. So this is where I come in here and enter in the asset, right? So I'm gonna type in here $50,000. What's gonna happen is a lot of this is gonna auto-populate. Okay, it's gonna go into some of these columns. There's a little method wizard right here that I recommend that you click on. Okay, this is gonna be a little bit of a cheat sheet for your useful life. Okay, so I'm gonna click on auto because I added an auto, and if I click on auto, oh, it's going to give me another little sub question, which is somewhat important. I won't go into it, but I know that this is a listed property because I'm just going to choose that. Okay. So now it's told me here's your method, here's your life, right? It's kind of filled in all this for me. I mean, your job as the prayer is to make sure that these columns get filled in too. AMT, ACE, no 160K, which is state depreciation, but I need to factor in all of this being updated. You can see what happened here. The default bonus. I put it in for 50. It's saying, hey, you're going to get 31,000 a bonus. Okay, that's going to be your current depreciation that you get. Book. You guys might be filling out the book. The auditors might have already filled out the book. I mean, we just need to be cognizant. Is that something I need to do? Is it something I don't need to do? What's been done in the past? Nebraska, probably pretty important. You guys are the first line of defense too for personal property taxes. Personal property taxes, and I'm not an expert on anything in this realm, but think about when we're sitting in here, desks, chairs, anything that's tangible property. Nebraska wants a little piece of the pie too, and each county assesses a personal property tax. So think about when you register your cars, you got to pay the motor vehicle fee, but you also got to pay a tax. Nebraska also wants tax on your personal property, computers, tables, chairs that you own as well. Well, we file those returns for all of our clients and we file them in here. Now, a robot actually goes through and does it all for us. We'll review it, but it's going to review what you put in there. So it's very important that this Nebraska column, we're thinking about, okay, is this PPT, and I'm not going to get into the PPT rules in here, but is this PPT really personal property tax? Well, I know for a vehicle, that doesn't count. So for me, I'd go in here and say, I know vehicles don't count. But if I had a table, chair, piece of machinery, equipment, I got to put that in there and fill out the method and life accordingly. I'm sure you guys will have a different training before that because there's nuances there that I'm not an expert in. Okay, but it is important. It's your job to fill this out first. It's your job. So pay attention to it, please. Straight line. So okay, I've added this asset in there. Again, the wizard kind of did it for me. Life makes sense. Depreciation all makes sense. All I have to do is click done, and now it's in there. Same method, if we go in there and we want to dispose something, there's a disposal tab. We've copied down, we say sold, we just tag in the date disposed, the gross proceeds, and now it's going to be calculating our gain loss for tax purposes. Okay. Some of the other items in here, let's see. I'm just going through some of the inputs up here, but there's client properties. If we've got to mess around with year-end information, short periods, again, seek help. There's people like, me and a few others who can do this pretty quickly. So if you've got to do something along those lines, printing. So, you're going to go in here, you're going to add your 4 cars, and then you got to go put it in the work papers. I'm sure you guys have been part of this, but we go up to the file, to the print. There's a sub, a pre-selected package of tax return work papers that print out for you. So it prints off kind of the 4562, which is where you input all the depreciation. I mean, these are going to be the work papers that go in, or the support that goes in your work papers. ads, details. I mean, each one of these tax group summary. I mean, a lot of the times what we're doing when we're looking at these, and I'll kind of show you guys something I'm looking for when this comes out is okay, depreciation. This is what's just going to match the software, right? What how you guys are going to input it in the software, okay? But you know, a good point of reference if you're ever going through this is I'd go look in this and say, okay, my tax prior depreciation, does my group summary, does that say 2024? If it's 2023 or not, you got a problem. Some of my prior depreciation, if I've got a file from last year, did everything roll correctly? Now, it doesn't happen frequently, but does it happen? Yes. People will go in there after the fact, after the tax return has been filed, and if they're doing planning, they'll mess around with stuff. They're doing the summer project, they'll mess around with something. Sometimes, it happens more than you think it does. And someone will go in there and mess around with something, and then all of the carryovers. It said last year we used 100,000 depreciation. Now it's only going to say if we use 60. Well, we used 100. So maybe sometimes double checking that. My prior depreciation says 0, but I looked at last year and we used 40. So what happened? Right? Someone went in there, maybe messed with it. Sometimes you'll catch that. Again, that's not frequent, not every time, but it's a good thinking point, I think, from a practical standpoint of did everything transfer over correctly? Does my beginning cost equal my ending cost from last year? If it doesn't, why not? Where to go? You know, things like that are always good. We'll call it self-review points for yourself, is making sure, because that's something I'm checking. When I pull the depreciation well, first thing I check is everything that was there last year, is that still here? Did that roll right? And if it doesn't, I'm gonna stop what I'm doing and say, what happened? Okay. But again, these are all gonna go into work papers. I mean, everything else in here, client status. Any questions about this software yeah, go ahead.
I guess like when you're filling out for Nebraska, is it better to default to like just assuming that it's going to be in Nebraska or not?
Yeah, yes. I mean, we have a personal property tax group that kind of works on this stuff. So there's a Nebraska column. If they got to do something in Texas, Maryland, they'll usually go in there and make their own updates. But it is important for you to fill out that Nebraska column. Okay, if it's a keyboard table, you got to put it in there, right? I mean, the only thing that you really would never add would be real estate, because you're ready to pay personal property or real estate taxes, cars, because you register that at the DMV. So those two things are never really going to go in there, or qualified improvement property. But think about tables, chairs, things like that will always go in there. That's your job, because when this thing gets submitted, the personal property tax group just goes in there and grabs that information. So you're the first line. You're the first and almost the last line of defense speeds them. So it's very important. And I don't know if Kaylee touched base on the personal property tax, but
She did not. But was your question, should you just default to this Nebraska?
the default in here is always Nebraska. Like he's probably saying,
I would say if it was all Nebraska last year, not a
Yeah.
bad assumption. But especially when it comes to the state bonus depreciation and add backs and whatever all that noise was that Kelly talked about and I wasn't paying attention to because I don't care.
but it's important, even though he doesn't care. It's important.
It's very important. So I mean, if you see somebody's in Virginia, Connecticut, wherever, and you're getting these ads, you're going to want to figure out where they are.
Yeah.
Both from a property tax perspective, a apportionment perspective. I mean, there's lots of data that we're going to be getting out of there.
I mean, even if you say no to Nebraska, I can guarantee you, on all the clients we have that are multi-state, we're tracking by location up here. I mean, just be cognizant of what's filled out in here, and don't just, I got my tax. A lot of people just say tax column, boom, updated, let's move on. No, there's more to it, and that's the whole goal here is don't fly through it. Again, you're gonna realize you do all this, you mess it up, it's a pain in the butt to go back and redo all this and reprint it and it changes everything. So you'll want to try to get it right the first time, your first swing at it. But other than that, I mean, there's utilities in here to import asset data. I know how to do it, but Brian Wellness said the Omaha office too. He knows how to do this. There's some other folks out there. So again, if you need 40 assets added, reach out, right? We have tools to get that in there pretty quick. Other than that, I don't know if I've got a whole lot of else that I want to touch base on, but any questions from you guys from what you've experienced or planning, consult, I mean, whatever you want to ask me. I'm sure Pete in his many years that he's seen good, he's seen bad. I mean, I'll even talk about, I mean, there's how important is depreciation, even if we forget about it. We haven't taken it, we have an asset that we added that we just never depreciated. Pete will probably talk about his 1245 recapture.
I would not. I'm not bringing up loud and loud.
Just-
No.
I've seen it. I'm telling you guys from experience, we had a client that added a fixed asset. We just were kind of moving along, never got it in here, never really, we put it in as a memo asset, never depreciated it. The client sells it, so they bought it for 50K during a 100% bonus. Should have been a $50,000 bonus. We just put it in here as a memo asset for some reason, so it got messed up. Well, when they went to sell it, they sold it for like 45. We were showing a loss, and technically speaking, they should have had a recapture event because they didn't take depreciation. And the rules say you have to recapture it, even though you didn't take it, you still got to recapture it. It was allowable, but you didn't take it.
There's a rule called
It's
allowed or allowable, and if it was allowed, but you didn't take it,
They don't care.
they don't care. So on that bonus depreciation, they, for basis purposes, still treat it as accumulated depreciation, even though you have a deduction. And when you talk about, have you guys heard the term cost segregation studies? Okay, that is the premise of allowed and allowable. That is hinged off that concept. Because what somebody builds a building, somebody comes in and does the cost segregation study, says, wait a minute, that ductwork could have been 7 years, all these items could have been 7 years, but you didn't do it. So you were allowed depreciation on that ductwork. So we're now going to quantify what was allowed, and you now can recapture what that depreciation that was allowed under a 3115 accounting method change. We talked very briefly about accounting method changes earlier. You can capture that depreciation and take that deduction as equity under the allowed and allowable premise.
Yeah, and so this was a lot of assets in this client, simple mistake, but again, something that was missed and, a whiff on our end, and that's just along the lines it got lost. So it's very important. You're the first ones in here. Just take your time in there, try to get it right. If it doesn't make sense, like Pete said, don't go through the motions, kind of challenge. I mean, a lot of this might be, repeat after a few clients, few asset adds, really not a lot to think about, but just be careful. I mean, in your overall process, self-review and being careful, but the whole goal here was to kind of introduce you to terms that you're going to hear, what you're going to see, what kind of the expectation is.